You'll make this rather snappy, won't you? I have some very heavy thinking to do before 10 o'clock.
Hey, Steve Smith. How you doing today?
I'm doing great. Brett Starr.
I'm Brett Starr, the CEO and founder of the Starr Conspiracy. He's Steve Smith. And so I say, he's Steve Smith, and you say,
he's Brett Starr.
Oh. It's Steve Smith, my business partner of more than 15 years.
More than 50 years.
A long time. Also at the Starr Conspiracy. Good to talk to you today.
Good to be talked to.
Today, we are going to talk about brand and the ROI of brand and the difference between brand and branding. And, you know, in many ways, so we have a new thought leadership article ebook out on this topic. We've dropped it in the description. It's a good one. And, you know, every time we talk about brand, I get a little frustrated because, and, you know, I'm also trying not to be frustrated about it. So, but it is a conversation that we have been having and driving really for, 15 or 20 years. And there are lots of things that change in brand and in marketing and in sales and in product and in customer success. But one of the things that I've not seen change over the period of time that I have been involved in helping to market technology companies is the relevance of brand and the power of brand and the impact of brand. Now, branding has changed a lot, how you actually create the perception of the quality of experience that people are having. But the fundamentals of like brand and the impact that brand drives has not changed. And I feel that we are constantly in the position of reminding executives, not the marketing folks, because all the marketing folks that we talk to, I mean, you know, for many of them, their careers are built on brand. But I feel like sometimes we end up, you know, kind of all getting in a circle of frustration together and saying, everyone says they believe in brand, but what are they doing about it? Mm-hmm. And also, why do you believe in brand? And, a lot of times people say they believe in brand, but they don't really know what they believe in and why. So anyway, let's talk about brand. Go.
Or they believe in brand until it comes to a point where they need to actually invest in brand.
Yeah. And, or yes, because a brand investment looks weird, you know, because most of the time, when people say, yeah, I mean, our marketing budget is huge and I totally believe in investing in brand and stuff like that. If they saw a pure brand experience campaign, if they saw an investment in a true brand experience that was really meant to drive brand recognition, functional association, brand attributes exclusively, and to, drive that perception of what the quality of time would be spent with a company. They say, well, yeah, but, you know, where's the link to the download form? Or, you know, how do we, you know, get this to drive leads? And, you know, that's not brand. There are brand components that go into demand generation, but that's not brand. So yeah, they believe in it until they see it in the wild tied to a budget.
Well, and I mean, I think that, you know, an extension from that is this, there was this article I saw last week in ERP Today, which evidently is a thing. But the whole article was about how, you know, enterprise software firms are changing their messaging. They're blending B2C and B2B. And I was just like, welcome to 15 years ago. This is not something new. I guess if you're an ERP and you're basically a decade behind the times anyway, that still might be cutting edge, but it just struck me as incredibly just sort of like out of touch with the broader sweep of what's going on in the industry.
Well, and what do people mean when they say blending B2B and B2C? What they're really talking about is, imbuing your message and your brand with attitudes, behaviors, and beliefs with psychographic elements, appealing to people's emotions.
Yeah.
That's always a good thing to do. That's always a good thing to do. But in crowded market segments, it becomes essential. And that's one of the big differences between B2C and B2B is when ERP launched, time out of mind, ERP was a fairly new concept in focusing on value proposition and, the facts, et cetera, was really, all you needed to do in order to establish your foothold in the market. But as those markets become more crowded and people have choices, you have to differentiate based on people's emotional reaction to the experience that they would have working with you. In B2C, that's always the case. I mean, if you launch a new deodorant, deodorant's been around forever and everybody's using it. So, you have to, thus the Axe commercials, appealing to a demographic of, 14 to, 21-year-olds, right? And what is unique about, their deodorant or their body sprays or whatever? Really nothing, except what they make you believe. And the packaging and, the way that they appeal to, attitudes, behaviors, and beliefs and psychographics. And that's where we're at in, several technology sectors is that they are incredibly crowded and you do have to differentiate based on personality.
Yeah. And so, when, you look at some of the research that we were doing as part of our, recent ebook that we put together on brand and branding, what I thought was really interesting was that only 24% of respondents said that their brand was resonating in market. Mm-hmm. So basically 3 out of every 4 brands isn't hitting the mark.
Yeah. And what do we mean? So this is pretty straightforward stuff, right? It's like, how do you know if your brand and your branding is successful? There's 3, primary measures: brand recognition, functional association, and brand attributes. Mm-hmm. Brand recognition is just, do people know you exist? Functional association is, do they know what you do? And brand attributes are where all those attitudes, behaviors, and beliefs are parked. What you're like as an organization, what the experience will be like working with you. And all 3 of those are part of a healthy brand. When you think about that, the ability to drive results in those areas becomes, much more straightforward because you know what you need to achieve. But what's often left out of that discussion is the evidence associated with doing that is a good thing. And so what evidence is there that performing well on brand recognition, functional associations, and brand attributes is significant and important to the success of your business?
It's just like, it's all kinds of things. It's just like, are you growing as a business? What is your share of voice versus competitors? How is it, affecting, sales conversions, it's across the board. How is it, how does it impact your employer brand? How is it impacting both your ability to recruit and retain new employees? So it's just like, it's across the board. It's really everything, but a lot of times, people know that, but then their behavior doesn't follow through on what it is that they say that they know.
Well, here's some stuff that we've proven when it comes to ROI. We've proven it several times. You've got examples and I've got examples. But one of the first studies that we did well over a decade ago around the relationship between brand and business performance clearly demonstrated that the order of brand recognition in a market segment is predictive of the actual market share about 12 to 18 months later, meaning that if I look at, the payroll, sector or the HRIS segment or whatever, and we do a brand study in that segment based on brand recognition, functional association, and brand attributes. On brand recognition, the highest performing brands, the ones who have the highest level of brand recognition, lead by market share about 12 to 18 months later. And they're about proportionate. And so if, one company has 3 times the brand recognition than the second place company, then their market share will be about 3 times that company in the future. So that shows a correlation between brand recognition and market share. But, really smart people back in the day said, yeah, but couldn't it be the market share that's driving the brand recognition? And when you do that in a longitudinal study, taking snapshots over time, what you see is that increases or decreases in brand recognition precede similar changes in market share later over time. And so we've also proven in long-term studies that it is brand recognition that comes first. Now, we say correlated, not causal, because of the silly rules around causation. You can't prove that it's not some other factor driving it, which, by the way, I think is a super high standard and nearly impossible to apply to anything in the world or nature. That being said, yeah, could there be, some mysterious, driver of business execution or whatever that first has an impact on brand recognition and then has an impact on market share down the road? Seems to me like if there were like a business execution issue, it would first impact market share and then brand recognition. But that's just me. We feel pretty strong in our assessment that brand recognition is a leading indicator. And then when you look at things like net lifetime value and stuff like that, those are driven by functional association and brand attributes. So functional association, for instance, if you look at expansion opportunities and net lifetime value associated with a company and its products, a lot of that expansion opportunity comes down to people to whether or not people even know that you have that other stuff. And that's functional association. And so the stronger your functional association, the greater your net lifetime value, especially as additional sales to what the original contract was. The first study that I led was really around Ultimate Software and Ultimate Software's performance against a cohort of competitors 15 years ago. And what we saw with Ultimate Software at the time is that the way that they budgeted for marketing and the way that they focused on brand building had a direct impact on outperforming their peers. And it was like a 1-to-1 correlation. Whereas other, and a lot of this was during the great financial crisis, when a lot of their competitors were turning down brand investment, they were turning it up. And you've got a great example with Cornerstone.
Yeah, I mean, that's, it's one of the really great early examples where, a company that really believes in the power of brand and investing in, marketing during a downturn comes from an also ran to an undisputed market leader, and so it's just like, that was one of the kind of the key points that, came out in the work that we did. And I mean, we brought it up in 2020 during the COVID downturn. It's just like, great brands are built out of tough times. Mm-hmm. And so it's just like, you have to have the courage to make a move that may seem counterintuitive at the time.
Yeah. And one of the things that you said when you put out this ebook, the content that you had associated with it, basically said, look, the work tech market is exiting the downturn, but it's not too late, to build a brand advantage. So tell us a little bit about that.
Well, yeah, I mean, it's just like, the whole idea is the reason for investing in, really across the entire, sales and marketing spectrum during a downturn is you can buy market share on the cheap. And so, so the whole reason you invest is so you can buy market share on the cheap, but then benefit as you're coming out of it, vis-a-vis that 18-month sort of like lag time.
Mm-hmm. So what evidence do you have that we are, exiting a downturn?
Well, if you look at, just the investment numbers, where things really fell off a cliff after Q2 in work tech investment, bottomed out in Q3, Q4 was not great, but we're seeing basically the third consecutive quarter of growth now.
Mm-hmm.
And so, to me, it seems pretty clear that not just in kind of watching where the numbers are going, but when you look at what is it that you're hearing from investors, it's just like everybody's looking at early stage, growth opportunities. That's where they're starting to put the money in. There's going to be a bit of a crunch in kind of the B2C round area, but it's very clear that there are a lot of unmet needs in the market. Mm-hmm. There's a lot of opportunity because of automation and AI, and so really what that's doing is it's propelling WorkTech out of this downturn. Even as when you look at the broader economy, the indicators seem to be pointing toward maybe heading into a downturn.
So I just want to connect the dots there a little bit. You're basically saying that there's evidence that we are, kind of exiting a difficult period in WorkTech because the amount of institutional investment in early stage startups. And I just want to put that in perspective because, as hard a time as I give to, institutional investors, whether they be VC or private equity organizations or whatever, I have a long history of saying bad things about them. I absolutely believe that they are a productive, beneficial force in capitalism and innovation. And I believe that they are filled with some of the most visionary and intelligent people in the world. And so, there have been times when, I made it sound like I thought everyone in VC were idiots because of, personal views about a couple of individuals at, a couple of specific venture capitalists, which I will not mention now because I'm trying to let go of my grudges. But the reality is, these large venture capitalists, these large private equity groups, they might make a couple of mistakes, but they don't, make the same mistake over and over and over again. So when you see multiple institutional investors increasing their investment in early stage companies in WorkTech, you can bet that a lot of smart people in a lot of different organizations have come to a similar conclusion. And that similar conclusion is that there is a growth opportunity where shareholders can make money by investing in these early stage startups. And that has to be, predictive of, the perception that there are buyers available to, drive that market opportunity.
Yeah.
And so investment in early stage startups, in, our experience running, a company in the WorkTech segment that serves WorkTech vendors for as long as we have, that usually maps to an expansion in the market opportunity shortly thereafter. So what happened, Steve, to, this, newfound religion and focus on profitability and, the party's over for investment and venture capitalists and, et cetera, et cetera. And, we're going to take our medicine and the world is going to change and we're not going to see the same Silicon Valley, in the next 10 years that we saw in the last 10 years. That's what everyone was saying. It was all over the place. What happened to that?
I think that there is a lack of rigor to that commitment that is becoming evident. Essentially,
Shocking.
Learned behavior over the past 2 decades is hard to let go of.
Well, and then there's the fact part of it, right? Which is that's not how you build new market segments. That's not how you create disruptive technology segments. That's not how you create massive shareholder value. You don't do it by investing in an early stage startup and then saying, how fast can you get to profitability? Mm-hmm. You say, how fast can you get as much market share as possible? And then we'll turn that into value.
Right.
There is an inherent value in access to market and in market share. And if you have a tremendous amount of market share and you're creating a great customer experience and you're not profitable, there is something inherently and incredibly valuable about that can be turned in to, direct, value in terms of profit and, financial returns. But it's hard to create profit and financial returns if you don't have market share.
Right. Well, and I mean, I think what's interesting is we know that there are a number of, companies that not only are doing everything right within work tech, they look good on paper, that are just kind of waiting to go public.
Mm-hmm.
And, right now market conditions are not conducive for that, except, you saw, the first IPO in a while, kind of in the tech area last week, SeatGeek, went public, and there's some rumblings that within kind of work tech, there was an article in about Parker Conrad and the information that basically he dropped some strong hints that, Rippling could go public more sooner than later. And I don't think it's going to take, basically too many companies hitting the public markets out of work tech and having a good showing to really get an attitude adjustment for the entire industry very quickly. And I don't think that is very far from being at hand.
Well, people may be tired of hearing it. But listen, success factors, Taleo, Conexa, these IPOs that happened when coming out of the great financial crisis. And the only thing that happened after that was the longest period of uninterrupted expansion in work tech history, not just work tech history. I mean, in tech history and, financial history, et cetera, et cetera. Here we are again, at least from a work tech perspective, where we're on the cusp of, what I think we know to be true, several bellwether work tech IPOs. And man, if that pattern, repeats itself again, which is what we've been saying for a long time, you have an economic downturn. There's the rise of a new organizing principle. And you exit that downturn and people are migrating from one type of solution to another. It creates a huge moment of solution switching. The leadership dynamic changes in different technology fields, and it ushers in a new period of expansion. And this period of expansion, based on the amount of pent up investment, if that's even a word, the ridiculous amount of investment. I mean, just, remind people how much investment has gone into work tech and how that compares to, say, the past 20 years.
I think it's $50 billion in the last 24 months.
And how does that compare to the last 20 years?
I mean, it's like the last 20 years rolled into one.
Yeah, all of it, right? And so we have yet to see the manifestation of that huge amount of investment. We have yet to see that turn into what surely will be the creation of large, healthy market segments over time. So all that investment, downturn, pent-up demand on the buyer side, major solution switching, moving from one paradigm to the new paradigm across a fault line generated by a new organizing principle. We're in for a 10-year run of ludicrous market expansion.
Yes. I mean,
otherwise, where did it all go?
Right. Well, I mean, there's well, when you think about, the amount of money that went into companies in 08, 09, 10, I mean, was, a sliver of what has happened in, since 2020. And, we're in an environment where, the fundamentals of work are completely undergoing a tectonic shift. And that's not slowing down. That's only accelerating. And so, technology is going to be highly involved in creating this future. And so to me, it's just like, it's incredibly obvious. It's just that we're in this period where, it's a period of readjustment. I think that the market has bottomed out and has started to head up, but that's not going to be clear entirely for another, 3 to 6 months. But I think that once it does become, clear and really come into focus, especially if there's an IPO or two that are successful in the next 6 months, which is possible, then it's just like, hang on, because it's going to be going.
Well, I'm going to drop another insight on you. And I'm going to ask our producer, Dana, mark this and drop it in the description, because I think people need to pay attention to this. And Steve, I think this will bring us back to why brand is so important right now. For years and years and years, we have tracked. So you and I and other people, the Star Conspiracy is a weird mashup of analysts and consultants and marketing professionals. We were the footprint of the modern agency a long time ago. A lot of people are trying to get into this, kind of unique position that we've been in for a long time, where you have, analysts and consultants and, people who know a lot about brand and marketing and sales and product and customer success, all within an integrated service delivery model. As part of what we do, we have been tracking all kinds of data signals about companies in work tech for a long, long time. One of my favorite things to look at is the funding to revenue ratio. So when we do a workup of companies in market segments, because a strategic buyer wants to know what companies are available, or someone wants to know what the competitive field looks like, we often throw in this thing that we care a lot about, which is the funding to revenue ratio of a particular company. And very simply, that is, how much funding have they received and how much revenue are they driving right now? What I've noticed over the past 2 or 3 years is, unlike any time that we've been tracking that information, the funding to revenue ratio is crazy out of whack, with funding being much higher than revenue. Okay. And so you've got companies out there who've gotten $100, $200, $300 million of funding who are sitting at $40, $50, $60 million of revenue, right? So really significant gap between the amount of funding and the amount of revenue. And I'm talking about widespread in work tech across every segment. It's the biggest gap between funding and revenue, and that funding to revenue ratio that I've ever seen. That's a trigger. It doesn't stay that way. At one point, the funding levels off. There's no more investment in that company that's already got its, 5th round or whatever. They don't need any more. And the revenue starts to go up, not just on a company level, but on a segment level for all of the companies in that cohort. And that's when you see that slingshot effect. We are at that tipping point right now where the revenue is about to start racing to keep pace with the investment that has been flooding in to the tune of $50 billion over the past 2 or 3 years, right? And so not something that other people track, not something that people pay attention to. We pay attention to it. And I'm telling you right now, mark the tape. It is a tipping point. Never seen anything like it spread across multiple companies and multiple segments in work tech. And something's got to give, because we're not going to see billions and billions of dollars of capital destruction of these companies just blinking out of existence. That just doesn't happen. The revenue curve is about to kick in. These markets are about to expand significantly.
Yeah, totally agree.
So why then is brand so important right now, to the point, we're about to sling, like we're getting ready for takeoff, IPOs, funding to revenue ratios, exiting a downturn. Why invest in brand now?
Because this is when the market leaders of tomorrow are made. If you're about to slingshot out of this, probably so are some of your competitors. If you want to be the leader in a market segment, the leader will be determined by who has the best brand. Period.
Yeah. Period. So I'll give you an anecdotal. We've given you some quantitative information about the relationship between brand recognition and market share around functional association and net lifetime value, brand attributes and, perceptions of the customer experience, et cetera. But here's just something really simple. When the slingshot happens, people are going to call the companies they know exist. Right. And if they don't know you exist, and they don't know what you do, and they don't know that you represent a solution that's on the other side of the fault line in this new organizing principle, then you're not early favorite vendor. And if you're not early favorite vendor, you're going to have a hard time winning a deal, because the companies who establish early favorite vendor status win a disproportionate amount of the time. And a disproportionate amount of the time, companies who establish early favorite vendor status are the first ones that buyers talk to. And the reason they talk to them first is because they perceive that that company is the dominant brand. Having no experience with that company whatsoever, they just say, oh, yeah, well, we know that so-and-so is the leader. They don't, what are they reading? An analyst report, about market share and, the quality of components in their solution. No, it's just, that's the brand that they've heard of. It's like you take sales analytics. Do people know that Gong is the biggest, best sales analytics solution in the world? No. Has everyone heard of Gong and everyone say, yeah, you need Gong. Gong is amazing. Yes. Does it matter that they probably don't have the best analytics solution in the world? I mean, it's great, but there are much more sophisticated artificial intelligence driven solutions out there. Gong's kind of playing catch up with a lot of that stuff. But if you look at Okta, Okta will tell you that Gong is the fastest growing app that's being installed on servers out there. That's brand, baby. That's brand. That's all that is.
Yep, exactly.
All right. Well, in the description, you will find a link to the ebook, Time to Make Your Move. Great brands are built during down markets. Please take a look, download it. You can find it on the Star Conspiracy website at thestarconspiracy.com. I'm Brett Starr. He's Steve Smith. Thank you for joining us today. And we'll see you next time.
See you next time.